All right, hey traders, this is Christian from Hertz Tribeca Trade Group with your weekend video. So, a lot to go over, a lot of strategy to go over, a little bit different than I think in the past weeks. Certainly, we've had a lot of different market moves go on, some big volatility that entered into the market. So, there's a lot to dig into. So, let's go ahead and just first talk about the SPY chart, and then we'll talk about last week's events. We'll talk about and then a strategy, your trading plan that you should have, and a game plan, playbook for next week. Right, those are some of the most important things. All right, so I'm not going to rehash, what we've seen in the last couple months, but it's been a pretty nice rally that we've had on our hands. And this was a great swing all the way up here. One thing, and again, the reason why I'm rehashing this just a little bit is just to show that the price action has been so strong in the SPY or in S&P futures or in the Dow, whichever one you look at. The price has been above the 20 period moving average, so that we know, the reason why I have both short-term, long-term moving averages on my charts to help me see the trend. And of course, price is the most important thing. But what we've noticed here is that we had one test, of the 20-period moving average, but since then it's just been up and away, and it's really been since the beginning of January the shortest moving average that I have on my charts, which is this yellow line, is the 5. The price action has been above there the whole time, and just about till this was not last Friday, but a Friday ago. Maybe a little bit too quick of a move up. We had an inside day, and then we started ducking under the short-term moving average. So what does this tell us? It tells us that number one, we lost the upside momentum, and we started to see a correction back, right? So then you start to look at once you lose the upside momentum, which is what we saw last week, is where are we going to fall into? And then it's kind of anybody's guess, because you just don't know. Nobody has a crystal ball, so I want to make sure everybody is aware of that. Nobody has a crystal ball and knows exactly where we're going to go. So the best thing that you could really do is look for levels that you could trade against. So, I thought that we would fall to the 20-day moving average, and then honestly, I thought we would see some support and possibly a tradable low here, but that's clearly not what we got on Friday. The bottom basically fell out on Friday, and not only did we crack the 20-day moving average, but then it becomes, okay, could we actually go all the way through the month of February's value area? Well, we did that, and we closed below. So this is some ugly price action. Have we seen this before in run-ups? Absolutely. There's always, markets can't go up in a straight line. So I'll say some things that everybody knows, right? Markets can't go up in a straight line. There's going to be times where there's going to be a correction. Now, the best thing that we want to do, or what we want to do, is assess and figure out what's the game plan going forward. So certainly there was a lot of volume. Was it the most volume ever? No. But we've got a couple bearish things going on here. So what I would want to see for us on Monday is whether or not we can get back into the value area. From my experience, I will tell you, because I've been trading since, I started trading way back when as a financial advisor back in 1990, the end of 1998. So I've been through a ton of market corrections, pullbacks, bear markets, short, long, whatever you want to say, and it becomes the same type of thing that you look for, and you look for support. Where are we going to hold, or if not, if we don't hold, where's the next line in the sand? And then also what has helped me over time is to say with my positions, and I'll get into how I'm managing my cash positions, but where's the lines in the sand for me to get out of positions, and basically use those stops so that losses do not become huge, right? We've all seen this back in 2007, which again, I'm not even going to bring up the chart because I don't even want to go there, but there's lessons to be learned from that, and basically not having any major major losses or drawdowns in your portfolio. So the one thing that concerns me is the distance between here and here, right? So the 50-day moving average, this is not tight because we've run up so far. We've got a decent amount. So Monday, we'll see. Futures open up in a couple hours at this point because it is now Sunday, almost at 4 o'clock. And it wouldn't be surprising me. Again, I don't have a crystal ball, but what I would be looking for, or what I think would happen, is that Asia would be weak, and then we also may see a move down on Monday morning. And then I would be looking to see if we can actually regain some of that levels. That could happen Monday, that could happen Tuesday, that could happen Wednesday. Usually these pullbacks, and we did start to see the pullback in the beginning of the week, although it wasn't really heavy, I would say. Really, Friday was the big pullback day, and sometimes it lasts 2 to 3 days. It's different every time, but that's generally, for the most part, when we see corrections or pullbacks, it usually lasts more than 1 day, especially when on Friday we closed on the lows, and we did that almost every day last week. And there wasn't very many buyers coming into the market. So that's why I think, being that we had that kind of market action on Friday, it tells me that there may be a little bit more ahead. All right. So the main thing, and I get questions from a lot of people because they, especially I think more, let's face it, more on the beginner side, I think people, once they see that the market's going down, they want to buy, right? We just haven't seen it in a while. And they're like, hey, this is cheaper than we saw. I want to get out and I want to start buying. So I want to do that too, but I want to make sure that we stop falling, right? I mean, I could have said it here. Oh, the 20-day moving average. That's support. Well, we broke through that. Next is the bottom value. We broke through that. Hopefully we can reclaim it. If not, it's the 50-day moving average. That's going to be the test. So I don't know whether or not that's going to happen, but what I would start to do is look for some confirmation, not to just go in and start buying just because things are down. So what I would say as well is, there's different things that we're going to watch. So before I go into that, the playbook, I want to just get into a little bit of last week's market action and some other things to look at. Because in the media, you're going to get a small view of really what's going on globally. For the most part, you turn on CNBC, as much as I have CNBC on, either CNBC or Bloomberg, and I'm not faulting them. And maybe I'm a little bit, but really they're just going to talk about the same things. They're really not going to look at global markets. I will watch them because everybody's watching them, and I want to hear what the sentiment is of the retail crowd, and maybe a little bit of the institutional crowd as well. And so, if you don't want to hear that noise, you just turn it off. But it's good for me to know where sentiment is, and that's kind of why I watch CNBC. I'm really not getting any valuable information out of there, other than I like a couple of the shows that are on. I think so. Let's talk about last week's what happened, and I think Carter Worth, who was on Fast Money on Friday, basically said everybody's looking for a reason for why these pullbacks occur. And I like what he said. He said, I'm looking for a reason. Everybody's looking for a reason. But at the end of the day, it's when markets are where they were, basically priced to perfection. Any bad news is going to kind of bring things down. So what was the killer last week? It was the volatility in bonds. We saw this in the German bonds, or the German Bund, last week. So again, our treasury prices really started to fall apart, last week. I mean, and you could see, they had broken the 200-day moving average, and there was a little bit of hesitation, a couple inside days or a couple pause, but we really started to go down pretty quickly. So this does affect, obviously this is bonds, but it does affect equities because it's the volatility, it's the quickness of the move that really gets people agitated. And it gets people to do things such as start to really worry about the markets when things are happening that quickly. We've seen it before, right? We've seen it in the commodity market a couple years ago when oil was really weak, right? There was all these people talking about, oh, there's no relationship between oil and between equities. Yeah, I mean, I guess on a fundamental view, yes, but markets are driven also by psychology. They're driven by emotion. So when people see oil go from whatever it was at, $100 all the way down and go down below 50, below 40, below 30, that eats at people's psychology. They think something is wrong in the market and they begin to take profits and they begin to or sell certain things. And then of course with oil, energy stocks are going to be affected. There's no doubt energy stocks are going to be affected by the price of oil. So you can't tell me that things, even though maybe there's no long-term relationship between one and another, but when something starts to happen in one market that is not equities, sure as hell certain things are going to be affected, and I'm going to talk about some of those. But what I want to start out with saying first, and I know we're already 10 minutes into this video, but it wasn't just the U.S. So I've got a couple charts, and I've got my charts of the week. And if you look at the German Bund, which has been trading at very low levels for a long time and not a lot of volatility and a really tight range, started to move. And this really started to affect German stocks on Thursday, which got no press whatsoever. So, that's, the value, a little bit of value that I bring to our trading room is I could tell you, hey, something's not right. Look at the DAX. Why is the DAX selling off and nothing else is? There's something that's not right. So I think the DAX ended up down about 4.5% over 2 days. But you could see, it's a pretty tight, this is different than our market, right? Because we were way far ahead of our moving averages. The DAX was not, but we've got a test next week of the 200-day moving average. So that is the first chart to keep an eye on. Again, not a U.S. chart, something globally, right? Global markets, we're connected, right? I mean, if Europe sells off a good couple of percent, the U.S. markets are not going to start the day up 1 or 2%, or what? Not 1 or 2%, but flat. It's going to have an impact, right? These things are interconnected. So watch the DAX to see if it breaks the 200-day moving average. It really hasn't done that. If we go back and look at a 5-year chart, it's been in an uptrend for a long time now, since the middle of 2016. So things might get a little dicey if the DAX starts to break the uptrend. Again, why I look at the 200-day moving average, it's a great indicator of it, whether something is just very simply in an uptrend or a downtrend. And I want to look at simple things. I don't want to overcomplicate things. So if the DAX starts to break the uptrend line, that would probably be the first big market globally to lose its uptrend, and that's important. All right, so that's what I will be watching. That market, of course, closes 11:30 Eastern U.S. time. And then if you want to look at, if you don't have access to the DAX, which you can find anywhere, like investing.com has a good site for that. Also look at EWG. This is the Germany ETF. This has the currency effect in it. So that's why it's a little bit different levels than the DAX. The DAX that I just looked at is in local terms. The EWG has the euro effect in it, which is the euro's been strong, so that's why this is still above the 50-day moving average. But if one goes below the 200, the EWG will break the 50. So that is also something to watch for those German charts. So the 10-year yield, again, it's just kind of showing the same thing, that these things have moved pretty quickly. This also affects things like high yield bonds, right? Which every once in a while people will really focus on high yield bonds. We got that back in November when credit spreads really, the high yield bonds between treasuries really got very narrow. And that's the next chart that I've got here. Back in October and November, they got dangerously narrow. They're also at these very narrow ranges as well. So I would watch, and that's another thing that's again, doesn't give me such a warm and fuzzy feeling is that the HYG, the high yield bond ETF, could be breaking the 200-day moving average next week. It's a level to watch. That yellow line, 200-day moving average. It's held an uptrend line for a long time, and that would be a trouble spot. So you got several different trouble spots to watch next week, and I think if we continue to see these yields rise, as they could take a pause. It's really the speed of and the velocity of the move that is scary. So it could, I'm not overall that concerned. You go back to my newsletter, and we talk about the levels that we are. This is still very low levels in the German 10-year Bund. So if we hang out here for a little while and gradually move up, I don't think it's going to be the end of the world, because the market can adjust to it. What the market doesn't like is those quick, fast moves. So that's number one to watch if it still is very quick. The German market, the high yield market, if we break the 200-day moving average, I think that's troublesome. And so then I wanted to get into a bunch of different sectors where the move in yields, what is really sensitive in the equity market. So let's start with home construction. Why am I starting with that? Because it saw the biggest weekly outflows on record. This ETF, it's the Itb Etf, and I know it's called the home construction ETF, but you have to actually look to see what's in it. And let's see, which chart do I want to pull away here? I guess we could do this one. So if you look at ITB, and if we go ahead and look at the components of this, again, with any ETF, it's always important to look at what's in the ETF, not the name of the ETF. Actually, let me just bring up the components here. So it's your home builders. It's DHI, it's Lennar, it's NVR, it's Pulte, it's Toll, and then we get into Home Depot and Lowe's and so forth. But the biggest five names, the top five names are the home builders in it. So those areas kind of saw a knee-jerk reaction, and we could talk about that in my fund flow report that I put out every week. And you could see that there were, in this ETF, there was $417 million outflows last week. That makes 581 in 2 weeks, right? Because what happens when interest rates go up? The home ownership becomes more expensive. The mortgage rates go up, and you're dealing with a whole nother set of variables into how much can you afford for a mortgage, right? Now, if that becomes more expensive, it's going to be harder to afford a $300,000 house or a $500,000 house or $1 million house, because the interest rate, which unless you're paying cash for your house, then it's a different story. But if you're financing it, your financing is going to be more expensive. So that is why we saw such a knee-jerk reaction with money being pulled out. And I will show you this on Bloomberg. So if we bring up ITB, and again, this is outflow. So Bloomberg tracks this. This is really nice because you don't have to guess what the amount of money is, whether or not people are moving out of or into something. It's measurable through the creation and redemption market, which brokers do. Associated participants will actually create and redeem shares to offset the demand for either buying or for selling. So if we bring up a weekly chart, you can kind of see what I mean. That's the day-by-day action. But you could see that this is by far the biggest weekly outflow. And you could go back. This is 2008. Of course, this fund is bigger than it used to be. But you could even pull up a monthly chart. And you could see that this is the biggest outflow that these have ever seen before in a given weekly basis. All right, so how can you profit from this? I put out this ETF fund flow report every week. These are what's known, I think, as a little bit of weak hands. When things happen this quickly, when they take money out that fast, sometimes you could see a reversion back. So what I would be watching in this home builder ETF which has been a darling of the last year. Sorry, as I flip around different charts, not this one. I want to go back to this one, and I want to look at the 5-year chart or even a 1-year chart. The 100-day moving average. So again, and I see some people say, oh, well, this is just a small pullback. It's only 2%, yada yada yada. It's fine. Everything is good. I would not really rest on that. It's great that people have. I've traded through all different types of pullbacks and corrections, but you don't know how deep it's going to be on the first day. So especially when we close on the lows. So I always want to worry about the risk. I don't want to think about how much I can make because there is a pullback. I want to think about where I could really get hurt. You'll find that the really good traders, Paul Tudor Jones, one of them, is always worried about his risk, not worried about, hey, how much can I make because the market sold off. But this is an 11% move from high to low. And there's a lot of areas that did that last week. So depending on what group, if you were in any of the commodity space, I mean, look at the metals and mining space last week was down 9%. XOP, oil and gas, was down 9%. Chinese internets were down 8.5%. It's been a big momentum play for the last year. So this is not. These are deep moves, right? So you have to be cognizant of that. And if you're just looking at one particular index and you're like, oh, it's down 2%, not that big of a deal. I do think, things going down 10% in 1 week is a very deep, is a pretty deep move in a quick amount of time. All right, so. Yeah, I would express caution in this. What I'm getting at is I would express some caution, going into next week, and look for actionable setups. So again, I'm going to get to that playbook for next week. Just the raw numbers. What benefited XLF. So financials. They are usually a positive recipient of when interest rates start to move up. They usually benefit. Again, I think you have to be cognizant of the speed of the move, because even financials were down 2.2% on Friday. Why were they down 2.2%? Because those little relationships where when yields go up, financials usually do better, banks usually do better. Those will break down in the short term if there's a little bit of paranoia out there in terms of selling. Nobody can. Oh well, this should be fine because of the, because of that relationship. If people want to sell, they're going to sell. That's the bottom line. So we'll see if this 20-period moving average holds up. That's something that I would be watching as well. And you could see some of these other areas that I've got, in this table. Besides the home builders, which is lumped into consumer discretionary. Really, the REITs, which are very interest rate sensitive, they had $693 million of outflows. Healthcare actually had a lot, as well as industrials and utilities. Utilities is another area that both utilities and REITs, those are equity yield proxies, right? So when interest rates are really, really low, investors will go into utilities, they'll go into REITs to try to get a little bit of extra yield. The problem is when those yields start to crank up like they did, the people would rather be in treasuries because they are. It is what it is. You could debate this if you really want to, but treasuries historically are a safe asset. All right. So you could certainly see that there was a lot of money taken out of there, and keep in mind these numbers that I put together every week. It takes a day or two for the, you could still see that there was $5.3 billion of inflows that happened last week into U.S. equities, a little bit less than that going into international. But it takes a few days for the creating and the redeeming to flush out. So, for example, there's a deadline at 3 p.m. to put in redemptions. And clearly the market action on Friday went all the way to the bell. So what we'll see on Tuesday is probably a decent amount of outflows. My guess is because again, it takes a couple days for it to trickle through, and for market makers to actually do these creations and redemptions. So I would look for Tuesday to maybe see what the real damage was in terms of the selling that happened in the ETF space. Again, just to kind of this is another reason why I would be a little bit concerned is that there was a report out a couple weeks ago when TD Ameritrade reported their earnings, and they were saying that cash balances among retail investors are at the lowest levels that they've seen in years, right? So if cash balances are really low, there isn't that money to come right back in and buy the dip, which might be why there might be a little bit more downside, because there are not high cash balances right now. And I've seen that's been backed up by what I've seen in terms of ETF fund flows. Every week we've been seeing at a clip of about, the week before it was $6 billion of equity inflows. The week before that, I think it was also $6 billion. So it's been running hot. There's been much larger inflows than what we historically see. So that worries me a bit, because there just is not a huge abundance of cash on the sidelines like there have been on previous dips. All right, so those are some concerning things, and that's why I'm a little bit, I say the same word again, concerned, or a little bit more worried. So the best that you could do is look for some tradable levels and look for things to subside a bit. So what am I watching? So let's go to my playbook for next week. What I would be looking at is the option activity, right? This stuff on that I have on the left of my screen. What we do all day long in the Tribeca Trade Room is read the tape. And I do this for several different reasons, and I think I have this here, which is good to talk about because I don't talk about this every week. But using option activity, and this is not the most pretty graphic in the world, but I'm a trader. I'm not a presenter, really. So I'm not a salesperson. But what do I use option activity for, right? I'm using it for trading ideas. I'm using it to spot momentum. And certainly that's what we've seen in the last few weeks. We've seen a huge amount of higher than normal aggressive call activity than we've seen in the better part of 2017 and the better part of 2016. The month of December and January on a day-to-day basis, if you kind of look at, and I'll give you some examples, if you look at a couple days that we saw a few weeks ago, I couldn't get the option activity to fit on one page. This is 123, 122. I mean, I even had to weed out, I had to decrease the font. I had to weed out some of the activity. So what did we see last week? Let me just skip ahead. Friday. Look at the font. Font is really big. You could read it, right? Because there just wasn't a lot of aggressive call buying. We didn't see that any day last week. Maybe one day last week. It was really, really light. Nobody was buying. It was very selective. I don't want to say nobody. It was just very, very, very selective. That was happening last week. So what I want to watch for Monday, and I don't know if it's Monday, but maybe Tuesday, is I want to see those aggressive call buyers come back and really pick their spots in different names. Maybe it's weeklies that they go crazy in a couple names, or they go further out and they buy some big chunkier blocks. Those are typically what we see. Either the weekly small stuff like repeat, like machine gun call buyers in BAC or an AMD or something like that, or they go chunky, out a couple months and put in, $1 million premium order in several names, and also the amount of the quantity of orders and different names that they're going after, right? So that's what I would be looking for on Monday morning. Again, the last 2 hours of Friday, I was combing through even after hours just to make sure I didn't miss anything, because I think a number of people kind of said the same thing. This is what we were talking about. I said, hey, if somebody is going to really come in and buy something big here in the last 2 hours of the day on Friday, I'm all about taking a look at that trade. But we didn't see it. There wasn't a lot of aggressive put buying either. It was some rolling out of transactions. We saw that all throughout last week. A lot of rolling of profits, taking down February positions and going out to March or April. But the aggressive stuff, where people have conviction, we didn't see that, especially the last couple hours of the day on Friday. It was very, very dry in terms of anything aggressive, except for like a couple deal names, right? Like ERJ. Oh, okay. Well, I'm not gonna buy ERJ because it's a deal name. Um, you know, Especially when the market is moving as fast as it was on Friday. A couple other things like Win. We saw a Win call buyer. Obviously that has a lot of other things wrapped up into it, right? I mean, that's got a whole another thing going on. All right, so so other than that, I use it for the option activity for sentiment, risk appetite, and rotation. Sometimes we'll see a whole group see call buying, like the energy or banks, the financials. Sometimes we just see them go after one group, and it kind of tells you, hey, all of a sudden there's a big appetite for that particular group. But really, all this funnels down into is your own trading system, your personal trading system. Why? Because all those aggressive call buyers, they're not going to call you on the phone and say, uh-oh, I think I made a mistake buying here, or I'm dumping those calls, or I'm going to hedge using the stock. They're not going to tell you what's going on. So you have to rely on your own trading system. Again, these top two things are what I'm really looking for when I see those aggressive call buyers. Maybe more on this week, it'll be sentiment and risk appetite. But in normal conditions, I'm really just looking for why somebody's buying. If somebody's buying a big block of calls, I want to go into the chart and see if the setup, if it meets my trading plan and my trading system. All right, so that's that could probably be said here. So, my point is you cannot rely on what's going on in the tape. There's been a number of institutional investors who've had horrific 2017s. They had bad Januaries. So if those guys are doing the buying, I don't want to follow some of those guys unless it meets my criteria, right? Why I think it. And same thing on the downside. What are you going to do? Sit in a trade that is, you're going to lose 50% on or 75%? Like, oh, well, somebody bought it, so they have to be right. No, it's not the case. And I think people on Twitter read into it way too much. This aggressive call activity has gotten a huge following in the last couple of years, and people are not thinking about it half the time rationally. And they're like, even when a move happens, sometimes a move happens in a name. Oh, was there a call buyer in the name? Why? Who cares? Why would that matter to you if there's an aggressive call buyer in the name? They could be buying stock too, as well. Is it a helpful signal when we see something go up and there's an aggressive call buyer and somebody's positioning? Sure. Okay. Yes. That does help to see that, and again, goes back to up here, gives you the trade idea, but it's not the only thing, and it's not even, and that's why it's in a bigger font, is so much more important than individual trade, individual option flow. All right, so I wanted to go over that just so you know. It should only be one of the things that you look at in your trading plan, and again, these four things is really what I look at for it. So it's good to touch upon that. But for next week, I think it will be number 3 is what I'm really concentrating on to see if buyers come back in. Again, I don't want to be the first buyer back in there. So when we were talking about the SPY chart. It brings to mind, and I said this on the on Twitter this weekend. What's the movie Animal House? And I forget the guy's name, but they're in a fraternity, and the whole speech where he's like, "Hey, let's go out and let's go get those guys. Who's with me?" And he runs out the door, and nobody's following him. right? You don't want to be that person that trader who is the only one who's buying and the crowd is not behind you, right? So that's what we're going to be looking for next week. I know that's a really bad story. Okay, so the other thing that I'm watching next week is the VIX, right? The VIX is a really good gauge of that volatility. Volatility came in a little bit next week, and this was a little bit caught a lot of people, including myself, and I'm not ashamed to admit that. If I can bring this up a little bit further, which Thinkorswim is not letting me do. I need to zoom out here, but it's not letting me do that. I'm on the right chart. There we go. Perfect. Okay, and now I want to zoom in. So yeah, we saw this spike up in volatility like we've seen before. I went ahead and sold some credit spreads in VXX, which I have plenty of time on, so I'm not crazy worried about it. But we've seen this before, spikes up in volatility and they fade very quickly. So notice we did not get that on Friday. So this needs to come back in, I would say below 1477, really below 14 and really further below 13. So this is, if something is really up in the marketplace, you're going to see the VIX get above probably over 20. Then we've got some trouble on our hands in the overall market, and I would not be buying a dip there until it starts to really trail off. Right now it's rising, so I'm not buying while the VIX is going up. I want to be buying, and I say this, looking at the 5-minute bar when once the market opens, and if we start to see big green bars, what I want to see is big red bars, and I want to see confirmation. And again, 1452 is right around that trend line, which is the 200 period moving average. That tells you uptrend or downtrend. So once the VIX breaks that, it's a good point to maybe reassert a trade and then maybe look to buy the dip. But I don't want to be doing that when the VIX is moving up to the big side. All right, so that's kind of some of the major things, and that's 35 minutes of talking. I'm not going to go over next week's option activity. That's more for the option activity from last week. That's more for Tribeca Trade Group members. By the way, you can, I think this is a great time to become a member of Tribeca Trade Group, because I've certainly have done this over and over and over. It is, it is a good exercise if you have not seen this volatility to get used to, not maybe used to it, but understand how it works and have a playbook for trading it, right? And that's what I do. And I've got a really good system for watching and picking up on those signals. So you could go over here to TribecaTradeGroup.com and you could go to our products page. And what we're doing for the first time is you could get a two-week trial, free trial, to see what it's all about. And if you're a serious trader, I think that you will love it. We've got a number of day traders. I'm more of a swing trader, but we've got a number of day traders in the room, and they are tremendous traders. So so we'll be going through our playbook pre-market on Monday morning, and then I'll be concentrating. But I think, giving you, thank you for watching the video, but really I think the DAX is what you want to look at. You want to look at rates. You want to be looking at the VIX. And again, this video is just for informational purposes. So when I say you, it's really me. I'm not telling you what to do, but really the move in rates is what I want to be watching. HYG is another area to watch, and we'll be putting that all together, and then hopefully, we'll get a tradable bottom. We'll maybe Monday, Tuesday. Again, I'm not predicting that. That's just with using those 5 or 6 things that I mentioned. Those will be areas of the market that I will be watching, and I'll be looking for confirmation, right? That's the big thing, is I'll be looking for confirmation that some of these trouble spots, either the support is holding, or things like the VIX, like volatility is starting to trail off quickly. And then, going back, which I didn't go over every single chart of the major US indices, but I've got that all in our newsletter. The Dow, it's got to reclaim and get back into value for the month. If not, I would say the 50-day moving average is going to be the next line in the sand. And those, I have all those charts in the weekend newsletter, which you will also get for your free trial. All right, thanks for watching. I did put out a poll this weekend about what do you think will be most exciting, more exciting with the Super Bowl, which will be in a couple hours, or the watching Asia markets. So we'll see what happens. I think they'll both be exciting. One eye on one eye on the other for me, and we'll go from there. I hope to see you in the training room bright and early Monday morning. Have a great night, everybody.